Well, guess what? The market is just made up of a bunch of bozos. And I'm just one of those bozos. But I've got so much to tell you today that I don't know if I can even get it all in. And part of it will be about the bozos in the market. This is Randy Kirk. If this is content that's useful to you, I'm going to put out a special plea today. I need some people to join Patreon. Chasing the algorithm, it's getting me an okay income. The ad sales are okay, but it is not enough to pay for what I'm doing. I have a team in the Philippines that helps with editing and helps with all of the things that I do, and I have to pay them. Right now, the amount of income is not even enough to pay them. So really need some Patreon folks to step up. So it's only $5 a month, and there are benefits. You do get a lot of the content. I do put it up early, and we are starting some of these conversations that I think you might enjoy being a part of. They're longer and more detailed than the conversations you might have on Twitter. Anyway, let's jump into the subject for today. I'm going to start with Tesla today, and we're going to go to the market issues secondly. That's kind of the opposite of what I normally do, but I do think that a lot of folks are very interested in this whole question of why is Tesla still held down under 200 and under 300 and under 400. So let's talk about that real quick. All right. So let's start with the idea of the punditry. You know, I'm a pundit. I'm a little tiny pundit. There's guys that have big crowds listening to them, hundreds of thousands of people, millions of people paying attention to what they say. And they're trying to predict the market, and they try to predict what the market's going to do at their peril. When I tell you what I think the market's going to do, I said I thought it'll be flat this week after the Fed decision on Wednesday and the big sell-off. I said, you know, now the market will kind of be flat going forward. There's like nothing going to happen for the next couple of weeks. But you know what? It might go up 1,000 points on Monday because of some news or because of something that happens or just because. And so predicting the future, really, really hard. Second of all, the punditry also looks back at the day that just passed or the week that just passed and try to explain it. And once again, that's at your peril. I mean, nobody really knows. Yes, there's days when you do know. You know that when the Fed spoke on Wednesday, and when at the very end of everything, he says, oh, by the way, there's not a chance in the world we're going to lower interest rates this year, and the market went down 500 points. You can pretty well say in real time, that's what caused the 500-point drop. All right. And maybe you could even go on Thursday and you could say, hey, the Thursday response on Thursday morning going back up a couple hundred points. Well, that was because people had time to think overnight about the entirety of what the Fed said and the entirety of the market circumstances at any given time. But the truth is, nobody knows. And why don't they know? Because the market is so complex. There's so much going on. There are so many different people out there making decisions. Sometimes I wake up in the morning going, yeah, well, how come people aren't buying Tesla today? What do you mean people? You have people that hate risk. You have people that love risk. You have people that are young. You have people that are old. You have people that love to be involved in go-go companies and people that only like to be involved in Costco. You have people that you have people that are putting their last dollar in the market, and you have people that have 50% of their cash on the sidelines right now waiting for an opportunity. So many different kinds of people making those decisions every day. All we see is the aggregate of those decisions. I think that's really important to keep in mind when you're thinking about the market. Better to think about the market in terms of your own strategies, your own goals. I'm not an investment advisor. This is not investment advice. It's the way I do it. What are your goals? What are your strategies? Stick with your strategies until your strategies don't work or until you get a better strategy. And I think you'll be fine. That's what I do. That's what I'm suggesting to you. All right. So let's go on then. A couple of things we do know. Fear and greed move the markets. Okay. Rumor and news move the markets. Technical analysis moves markets. People see the technical getting to a certain point. Not only people, but computers see the technicals getting to a certain point and they buy or they sell, and that moves markets. Fundamentals are the best long-term way to determine how the market's going to move. That's fundamentals with the individual companies that make up the markets. That's fundamentals with regard to the overall U.S. economy and the overall world economy, and any regional or institution or industrial, like in one industry, like the auto industry, might have certain kinds of fundamentals that are changing that would cause the market to move. These are all the kinds of things that we know move markets. But they can almost be irrelevant in the short term. And this is really important. All of those fundamentals sometimes get thrown out in the short term because of news or because of fear and greed. All right, so now let's talk about Tesla. In light of all of that, let's talk about Tesla. All the reporting is suggesting right now that Tesla's Q1 will beat their Q4 in unit numbers. All right, and they will beat the street estimates. So the street estimate is around 420 right now. Troy Teslike and others are saying that it's going to be more than 420. And that's based on the latest information coming from all the resources that Troy looks at. So you would think that Tesla, because fundamentally is doing well, you would think, oh, maybe it should be doing better than the market. But in fact, today, it did worse than the market, even though Randy keeps telling you that Tesla is going to follow the market right now. It's going to follow the macro. Well, it followed the macro. If you look at the numbers all day long, it was kind of following the ups and the downs all day long. But at the end of the day, it was still in the red and the market was slightly in the green. How does that happen? Who knows? It's all magic. And I'm not going to be the one to be able to tell you how that works. All right. But the truth is, right now, everything that happened this week with regard to Tesla was positive. I can't find, this is Good News Friday. I can't find anything in last week other than the Fed raising interest rates a quarter or 25 basis points. I can't find anything about Tesla that would have caused any kind of negativity in Tesla stock this week. And I looked just before I went on this episode, I went and looked at everything on Twitter. I went and looked at everything that, in the news. There was no news today. There was no reason why Tesla should have been slightly off compared to the market at the end. Can't find anything. Now, maybe there was something. Maybe it'll pop up later. Maybe there was options trading that was taking place. I don't know about that. So Tesla is doing great. Their fundamentals are amazing. And with what I've talked about last week, you may want to take a look at my Wednesday I don't think, was it Wednesday or Thursday? I put out a thing. Yeah, I think it was Thursday. I put out a thing talking about Tesla as a value stock. If you haven't looked at that, you might want to take a look at it. I talk about in detail what I'm going to say here, and that is there are probably fewer than 50 companies in the world that have $20 billion in net cash. Tesla has $22 billion in cash, and they have $1.5 billion in long-term liabilities, or long-term notes, rather. So net cash, they're at over 20 billion, and it's probably more than that because we'll find that out next month. But the guess is they will have thrown off a little more free cash flow. They are also throwing off free cash flow every quarter at levels that most companies envy. There's very few companies in the world throwing off as much free cash flow as Tesla is. And there's no company in the world now, and I'm pretty sure there never has been, who is growing at 50% per month, 50% per year, year over year, and with projections of growing 50% year over year into the future at this level of existing sales and profits. When you get to this big, they say, the rule of large numbers takes over, and you can't grow that fast into the future. Well, Tesla is. And they're proving it over and over again that they have the ability to grow at these numbers. And there's a million reasons for that. This is not the time for me to go into the reasons why. So largest amount of cash on the books, or one of the companies with the largest amount of cash on the books, one of the companies with the largest free cash flow being thrown off every quarter. And that free cash flow is not being thrown off because they're just taken in the income that they've been building up, to take all these years. No, they're still spending CapEx like crazy, building factories all over the world, and their CapEx expenditures are very, very high. So this is a very unusual company. In fact, I make the claim that it's the most unusual company in history. And then it doesn't even count the other parts of the company, like energy storage. The Bradford Ferguson and I had a conversation last night. It will be coming out tomorrow morning. You should look for, tomorrow afternoon, probably around 2 or 3 o'clock Pacific time. You'll see the episode where I'm going to be talking to Bradford Ferguson. He spent 5 days in California, visiting the Tesla factories, the multiple buildings and buildings of factories that are up here in Northern California, near Stockton. And these factories, one of these factories at least, is making these megapacks. All right. And he's not, I'm going to give you a little bit of a spoiler alert here. He knows how many units were being thrown out per day or over that 5-day period, but he's not going to tell us. He wants that information for himself and for his investors, for the people that he gives investment advice to. But he's going to reveal it in mid-April. So look for that. In mid-April, he's going to tell us how many that are coming out of that facility. Now, having said that, he intimated clearly to me that it's at least 10 per day. Now, these are $2 million a piece. So that's $20 million a day. If you multiply that out, that is, I've got it here down here. It's like about 8 billion in sales per year if it's only 10 a day. Now the capacity is 25 a day. So that just multiply that times 2.5. Now you're at $20 billion a year. Most people feel that the profit margin on these is about 50%. So at about 50%, right now they'll be throwing off $1 billion a quarter, maybe $2 billion a quarter in profit. $2 billion per quarter would be 66 cents a share. And with the growth on this expected to be over 100%, then the PE on that portion of the business should be 100, and that would put us at $66 just for the mega packs. And of course, the market is not giving them any, they're giving them 0 for the mega packs. Now, part of that reason is that big companies like Tesla, with multiple billions, over 100 billion very soon, if they're not already at a run rate of over $100 billion in sales per year, companies that size, they're not going to give any credit to the smaller divisions of the company until they reach at least 10, 15, 20%. So that's just the way things are. If that was a separate company, it would have, which I've been recommending that they spin it off, that company would be worth a whole bunch. So just have to realize that none of these smaller portions, none of the smaller parts of Tesla are going to be given any credit until they reach 10, 15, 20%. Well, okay. With all that in mind, Tesla doesn't seem to be able to break $200. It did break 200, then it went back under $200, trading in a range now. It's my contention that Tesla should be acting more like Apple. That was the argument that I've been making for a couple of weeks now, that it is a value stock. Both Moody's has now joined S&P, and it says, yes, it's a blue chip stock. And obviously it is. Everything that I just talked about makes it so. So it's a blue chip stock where people should be willing to put their money in a risk-off environment like this. Say, they're putting their money into treasuries, they're putting their money into, things that are very, very dependable, that even if it's a lower return on investment, they know that it's going to be there when they need to get it. Now, why isn't Tesla seen as a value stock? Well, because the market value, because the stock value jumps all over the place. We had a 7% jump the other day. We've had 3% down the other day. So when a stock is vacillating that much, and a lot of that is driven by options, a lot of options players out there, it's the #1 stock for options play. And so that also makes it more volatile. And the fact that it's making it more volatile, the volatility makes people get into options because you can make a lot of money on volatility if you're an options player. Okay, I'm running out of breath here with all of this, but okay. The truth is that we're hoping, I would hope, my expectation would be that Tesla will be seen as more of a value stock as the year progresses, as each of their as at each of their earnings calls, each time they're showing more earnings in some of these divisions and showing that their margins are still above 20% and that their operating margin is still above 15%, I think the narrative will change, and you'll begin to see a little bit of a different attitude with regard to the stock itself on the market, and it should start to outperform the market. Having said all that, I don't see Tesla going back to 400. My number for 2023, I believe it'll go back to 400, but that is going to take the macro moving in that direction as well. It's going to take more risk on. It's going to take people taking their money out of the treasuries, taking them out of the 10-year bonds, taking them out of all of these, risk off kinds of investments and putting them back into something that has a little more risk involved. Okay, now, all right, let's see. Oh my goodness, so much to talk about. All right, let's talk about the market. The market is crazy. No, it's not. The market, I just watched Cathie Wood talking to Laffer. A couple of my heroes. Cathie Wood is amazing. Laffer is amazing. I'm going to put a link to that conversation below. You should be watching Cathie Wood whenever she's on. She just interviewed Laffer. And out of that conversation, the clarity just became more and more clear to me. It's so obvious. COVID started this whiplash going, okay? The stock market crashed because of COVID. Multiple people said it's going to be a V-shaped recovery. It was, and we're all thrilled that it was a V-shaped recovery. I made a lot of money off of that V-shaped recovery. But the truth is when you have that kind of a whiplash and all of the interruptions that took place because of COVID, it takes a while for things to even out again, to flatten out again, to become back to normal again. And as fast as one thing gets back to normal, something else is not normal. I know I've used the bicycle industry as my example over and over again, but it's such a perfect example. Every time the price of oil goes up, bicycle sales go up. Bicycle sales go up. As soon as the price of oil drops, everybody that wanted a bicycle already bought one, and all of a sudden you have a recession in the bicycle industry. So right now, the bicycle industry is in recession. Sporting goods is in recession. There's a whole bunch of industries that are in recession. And they're in recession because everybody bought all that stuff that wanted it, and they were desperate to get it because there wasn't enough of it. And then everybody overproduced it, and now people are sitting on inventory, but nobody wants it. This is a normal thing that happens anytime you have disruptions in the market. But this disruption was really huge. And then the government and the Fed and other governments around the world all interfered in the entire process. And the interference exacerbated the flips. All right. A lot of the markets are starting to mellow out. So clothing and some of the things that were over inventoried at the end of the year and probably into the beginning of this year, I think you'll find that clothing prices will mellow out going into the spring and summer. It's not going to be as crazy. If people take their hands out of their pocket and at least buy normal stuff, things like garments and whatnot will start to come back to normal. I think the bicycle industry, the sporting goods industries, the outdoor industries that were crushed over the last 9 to 12 months, I think they'll start to see a nice beginning to normal sales coming back. I could be completely wrong about this. And if I am, we're going into a recession. Okay, just as simple as that. Watch those subject lines and you'll know whether we're going into a recession or not. There's already evidence that people are back out buying houses again. Both the housing industry and also new home purchases, both up. Yeah, prices are down, which is good. But we're going to find out in the next few weeks. This is the spring season. This is when people start to buy. So you're going to see between now and June what happens to the housing market. There's no supply. There's no supply, just like it's been true for 5, 6, 7 years. So will there be enough interest? Will there be enough buyers to start to move prices back up? And what will happen to supply? If prices start moving up a little, will the supply start to respond to it? So that's another industry you can watch. Home repairs, watch Home Depot. what's going to happen with home repairs? This is normally when people start repairing their homes. They're taking breaks, spring break. They have a little extra money in their pocket from their tax returns. They start going out to Home Depot and buying things and fixing up their houses. Take a look at what happens with Home Depot stock. This is going to be some indication of what's going on. All right, so these are all the kind of things you might want to look at. All right, last two things. Let's see here. Two more thoughts. Okay. So part of this whiplash that we've been going through has also caused a whiplash in the way people are investing. So the investment public took their money out of the banks because the banks started crashing a week or 10 days ago. They took their money out of the banks, they put it into T-bills, they put it into money markets. And so now, and this was on top of the fact that we have record amounts of money off the table with regard to normal investments. It's in cash equivalents, it's in T-bills, etc. So we have record amount of money off the table. We have the very first time since 1948, according to Cathie Wood, first time since 1948 that we've had outflows, overall outflows from banks over year. We have one of the very first times, I think she said since 1938, that we've seen the money supply itself be down year over year. And then the multiplication of that money is going into negative territory apparently for March. So all of those things normally would point to a recession, would point to maybe even a really tough recession, a 2008 type of recession. But Art Laffer said in this one that I'll mention below, I'll put the link below, Art Laffer says, you know what? This is all part of this craziness. It's all part of the craziness. So it's a flight to safety, which is the reason we have such an inversion. We have all kinds of people that are buying 3-month and 5-month and 2-year treasuries. The 2 years have dropped like a rock this last week. They're down to under 4% today, 3.8, I think, percent, and they were over 4.5 last week. So, and you've got the 10-year that was at 4, it's dropped down to 3.35 at the end of the trading today. So that's still inverted, but it's only inverted by roughly 40 basis points. And that's much better than the 100, but it's been inverted for a year. That's crazy. Never happened before. Not a year. It's actually last July 5th is when the inversion started. So 9 months it's been inverted. This has never happened before in history. So this is my ending thought for you, is that these issues that have never happened before in history are because of the craziness of what's happened this last 3 years. It will probably settle out. The Fed overreacting over and over again is not helping. The Treasury overreacting over and over again is not helping. The government overreacting over and over again is not helping. You need the markets themselves to be able to adjust to the new reality and get things all straightened out. But the government keeps coming in and throwing another thing in that blows it up, like SVB. And the banking situation last week was unnecessary. It was caused by the Fed. It's caused by this rapid increase to 5% Fed interest rates. So there you have it. This is the problem that we're facing. I hope this has been useful for you. If it has, please let me know that you liked it. Please go ahead and subscribe. This weekend, great videos coming up. You got the one tomorrow about Lathrop with Bradford Ferguson. You've got one tomorrow morning, actually, that I did with John Gibbs and Scott. I'm really, am I getting tired here? and Scott Walter that talked about what the 3 videos that I did last week with Joe Justice. And we take a look at those and we break news. Believe me, we break news on that video that'll be out tomorrow morning, roughly, well, sometime 8, 9, 10 in California time. So that's enough. And then on Sunday, I'm going to do a review of the entire, all that's happened since since Investor Day with regard to the robot. So these are a few of the videos over the weekend that you're going to definitely want to take a look at. And then finally, join Patreon. Would you please? I'd like to, honestly and straightforwardly, I'd like to increase the income that I'm getting for the content that I'm producing, which is what Patreon is all about, because it's not really profitable right now. And in order to really continue to do it at this level, with this quality, with the amount of information, the amount of study that I have to do to produce it, I do need more income to be coming in from this effort. So Patreon would be a great way to help me do that. So with all that said, hey, it's been great talking to you today.